Hayes Miller, you're bullish on Japanese equities. They have the weakening yen in their favor, but are the fundamentals there too?
Yeah, Greg, so the thing about Japan, and the reason that we think it's a 5-year play, and we're only 2 years into the 5-year play, is that the first move had to be about monetary policy. The first move had to be about Abe and Kuroda getting on the same page and saying, look, we're going to manufacture 2% inflation on a sustainable basis. And what that allows them to do is to get rid of the deflationary mentality and begin to get their heads around the idea of growing their economy. And once that phase, I think, began, it was easier for Abe then to start a set of reforms that would allow companies to begin to grow their ROEs, to begin to treat shareholders more like shareholders, to consolidate certain industries, to reduce the amount of competition and cost structure so that growth could become part of the mantra. So, you know, you have to realize that Japan has been running at a market ROE of about 7%, all the while that the US and Europe is running around 15%. And Japan's on target for 2016 to have an ROE of about 12%. All because, I think, of this reform structure. So while the yen move and the weakening of the yen was a good Kickstarter, at this point we've seen most of the move, and we don't really need the yen to move much further than that to allow for Japan to organically improve their profitability.
What about the move down in the euro? We're getting pretty close to parity. How much more do we need from the euro to get European stocks moving higher?
So it's the same story from the point of view of global competitiveness. We knew that the euro at some point would weaken, but for the longest time investors were actually buying European assets off of the banks as the banks restructured. Now the banks have gotten to the point where they're fully recapitalized and they can begin to lend again. We're seeing lending numbers start to rise. We're starting to see the benefits of the weaker euro in both economic and earnings terms. And we're also, I think, going to see some benefit from the lower oil price economically. So all these add up to positive economic surprises. They should add up to positive margin surprises as this higher revenue flows through to the bottom line. And I think that, you know, if there's a market that's likely to meet or beat expectations this year, it's probably going to be Europe generally. I would say that there's a distinction to be made between Northern Europe, which primarily focuses on, say, Germany, Sweden, Netherlands, and Southern, because I think the periphery markets still have a lot of excess capacity and still have a lot of sort of drag, if you will, fiscal drag. But that should be working itself out over the next year or so.
And they have no problem making that distinction either. So finally, I want to wrap up with China. China's slowing, they're cutting rates. Should investors get into China before at all?
Yeah, so there's two Chinas. There's a market that's very cheap, where you can find really great deals, particularly in the financial sector and some of the other sectors. Obviously, we've had a property boom, and the government there is focused very much on trying to contain property prices. They continue to try to play around with different elements of monetary policy, lower short-term interest rates, lower, say, reserve requirements for the banks. But I don't know that the central government is really focused on shareholder value or growth per se. I think they're much more worried about social issues and structural issues. So at this point, I don't know that we're going to get the catalyst to really push China off of the platform of where it sits. But on the other hand, I think that Chinese investors themselves have become great beneficiaries of having a large liquid market, and I think they'll continue to buy their own stocks. So, you know, I don't think it'll be too much of a bad deal to buy some Chinese stocks for your portfolio today.
All right, maybe China's a stock picker's market right now.
Definitely, good
Thanks
idea.
a lot, Hayes.
Thanks, Greg.
And thank you for watching The Street.